Let's bring in Jerry Lo, China's strategist at Morgan Stanley, joining us now live from Hong Kong. And staying with us is Jim Rogers, chairman at Roger Holdings, live from our Asian headquarters. Jerry, thank you very much for joining our show today. You know, the Chinese market, or at least the Shanghai Composite Index, is up 47% year to date, by far one of the best performing global stock markets. How sustainable do you think this is? And do you think it's been fundamentally driven, or do you think the market is getting just a little ahead of itself?
Well, I don't think it's fundamentally driven. I think it's liquidity driven, just pretty much like every other market in the world. And the key difference in China, though, the reason it's doing so well is because China has a closed up capital account. That's very important to remember. Money don't go out. Okay, it's like a sealed up lake. You keep pouring water into it, and the water level will keep going up. That's the only trick. If you look at the loan growth in the first quarter, that's almost 5 trillion RMB in one quarter, which is almost 10% of Chinese GDP. So if you keep pouring money in the market like that, I understand why they do it, but that also explains why, you know, the stock market has been so strong. So I think it's a liquidity thing rather than a fundamental thing.
You draw a great picture there. You draw a great analogy with the lake. Jerry, when you say about, you know, just pouring liquidity into the lake and it just keeps on getting bigger and bigger. The problem is that eventually the dam is going to break and potentially it's going to spill over and end in tears. I mean, how long do you think liquidity alone can sustain a stock market rally?
I think it's rather a global question than a China question. I think for China itself, you were already seeing some deceleration of liquidity. I think in April, you're seeing a fairly sharp deceleration of the new loans creation. But remember, liquidity is becoming global these days. Money is still floating into China through both the trade account and as well as the FDI, even though the FDI has been declining. So I think, you know, at the point of when the central bank, you know, start to respond to these reflating asset prices, you're going to see a big problem. So for the time being, the rally could actually sustain for a few, you know, quarter, you know, or two. But, you know, eventually this is going to be a pretty bad, very quickly playing out boom and bust scenario for me.
But Jerry, are you suggesting selling China? Boom and bust
scenario, potentially, Jim.
No,
yeah,
I'm just saying,
you, Jim.
Jerry, are you suggesting selling China at this point?
Well, I am. I mean, for the next 6 months, I don't feel comfortable buying the market right now. I think at best you take it as a trade market than a buy and hold market. I think the risk reward is no longer good.
What are you doing, Jim, with China?
Well, no, as I said earlier, I bought Chinese shares in October and November. I bought no Chinese shares since then. Jerry's exactly right. I mean, there's a lot of liquidity, and the market's up 47% this year. I don't want to buy anything that's been going through the roof. And I think China's probably been the strongest market in the world over the past 6 months or so. No, you don't jump on a moving train. You wait for the train to slow down and go into the station and calm down.
The question is, of course, Jerry, that, will the... Sorry, go ahead, Jerry.
Yeah, I think, Jim, your strategy of keep holding it is probably right from a longer-term perspective. Don't get me wrong. I'm a secular bull on China. I think, the world is rebalancing. The emerging market where China's station is gonna take over the world economy. But, in the near term, I don't think China can just sustain the rest of the world. If you look at what's going on in the rest of the world, it's a mess out there. China is doing its best, to escape from out of this global recession, but I don't think it's going to be successful. You're going to see more bust than boom in the coming 12 months. That's the best I could take.
You're certainly going to see some companies suffering. I mean, anybody who does business with America, if you sell to Sears in America, you know something's wrong, and likewise with Europe. So there are many sectors of the Chinese economy that are going to have problems. As far as selling, Jerry, I'm not as smart as you. I'm not as a good trader. I own China for my children. I expect them to own my Chinese shares someday because, as you say, and I happen to agree, secularly, China is going to be the next great country in the world, whether we like it or not.
Yeah, I think you're right.
Jerry?
I think you're right. I think the China is going to be the world economy leader across the cycle. We're definitely a across the cycle buyer in China. What I'm talking about right here is there's likely to be a near-term asset price issue. The way what I worry about is there's so much liquidity, not just in China, but globally, okay? You got a wall of money coming to the asset market, and asset price start to stabilize and then reflate, and they're generating a head fake prosperity in the global economy, which I think is highly unsustainable. Wait until the central bank hit the brake and throw the passenger out of the window, and then I think from there we can talk about China's leadership, the sustainability of the long-term growth, etc., etc. Right now we're all on the same train, which is about to take a hard break. That's my opinion.
Jerry, as far as the near-term trading action is concerned, we have heard about new subsidies from Beijing for the purchase of automobiles and home appliances, really targeting the consumer sector once again. Are those sectors, specifically the auto parts sectors and the retailers, are they going to be in favour today and in the near term?
I think so. I think it is a trading opportunity, and but when it comes to really how much money is going to contribute to the company's bottom line, I'm really a little suspicious, because if you look at if you read the lines carefully, it's not really a new purchase subsidy. Okay, it's a replacement subsidy. You got to own a vehicle, to be able to enjoy that 10% government subsidy. And when it comes to white goods and TVs, any summer promotion is bigger than 10%. So I don't think it would be specifically appealing to the consumers that much. So all in all, I think it's probably going to pull up demand by something 5 to 10% max. I don't expect it to do much better than that. And remember, when this marginal demand is creating, the profitability is probably the lowest. We have seen that in the rural area, and I think we'll probably continue to see that when they deploy it to the nationwide.
Jerry, we've been talking a lot about commodity markets because, of course, Jim Rogers is on our show, and he's definitely a perma bull when it comes to commodities. But certainly key to the commodity outlook is China's demand for everything that, they gobble up, from agriculture to base metals to, to oil. What is your outlook for China's demand for such commodities?
I think there are two layers of that demand, okay? On the fundamental layer, it looks rock solid with this, multi-trillion stimulus demand out there and the government infrastructure spending, et cetera, et cetera. And the question is, on the margin, how is that going to trade off with the rest of the world demand when the U.S. is still slipping into a recession and Europe doesn't look like so strong either? So people could argue on the margin, these demand are at best flat globally. But remember, there's another layer of demand coming out of China, which is a strategic relocation of its dollar reserves from the paper to the hard assets. And these hard assets could be broken down into the hard commodities and the risky assets in these commodity producers globally. If you listen to the news this morning, there are two stories already out there regarding these M&As globally, in this area. So I think if you add on to that layer, at least in the coming 12 months, that these commodity and oil demand, globally will look pretty strong thanks to the China factor.
Yeah, I wanted to pose the similar question to you, Jim, without using your name in vain, or give you the chance to respond here. When you talk about what you see in the future for commodities, and you're talking about massive price rises for commodities, how much of that equation is due to China, do you think?
Well, China sees the same thing that I do. They know that the supply of everything is in decline until something dramatic happens, and they're wisely, in my view, stocking up. First of all, who wants to own U.S. dollars 5 years from now or 10 years from now? I'd rather own cotton or zinc. And second, they realize that the supply of everything is in decline. I think they're making a wise investment. Strategically, they're doing a wise thing by building up supplies if they need them. I mean, as I said to you earlier, I think that the commodities are the best place to put your money these days, and apparently the Chinese government had rather own real assets than U.S. dollars, which are being printed very, very rapidly every afternoon.
Very, very quickly,
yeah,
since we're on the topic of U.S. dollars, Jerry, did you want to respond, or else I'll ask you another question?
Yeah, I think I completely agree. I think the dollar supply looks like unlimited, for me, and you want to keep playing it until you see. I just want to remind, in the coming 12 months, 24 months, until you see signs that the central banks might actually tighten. I think that'll be the point when you sell the liquidity, sell the commodities and oil, temporarily and wait for a correction. But before that happens, I think there's way to ride in that space.
great conversation, guys. Jerry, thank you very much for joining us today. Jerry Low, China strategist at Morgan Stanley, and of course our guest host, Jim Rogers.